Professor Namyong Lee's commentary, long, if Korea's relationship network collapses, companies vanish and dollars flee. When the relationship network among stakeholder groups collapses, investment collapses with it. Companies do not leave because of a single emotion or a simple slogan. They leave because the stakeholder relationships that shape costs, risks, timelines, and credibility tilt in the wrong direction. The President and the Presidential Office set the nation's policy signals. The Prime Minister and ministries determine execution speed and consistency. The National Assembly changes the cost structure through laws and taxes. The courts and prosecutors decide how quickly disputes end and how predictable outcomes are. Regulators and local governments control on-the-ground costs through permitting, inspections, and discretionary enforcement. Labour unions shape the productivity path through bargaining choices. Companies deploy the hard ammunition of facilities and jobs. The financial sector prices risk premia into interest rates. The media and civic groups raise or lower legitimacy costs. Citizens fix or correct the entire structure through their votes. If this network is balanced, companies stay. If it hardens into conflict, companies leave. Companies will invest even under high tax rates if the rules are predictable. Companies will not invest even under low tax rates if laws and interpretations wobble. Korea's crisis begins not from high costs, but from not knowing when, how, and how fast costs will rise. The numbers already show movement. Korea's outward foreign direct investment in 2024 was recorded at USD 63.95 billion. In 2025, outward FDI was reported at USD 14.15 billion in Q2 and USD 16.06 billion in Q3. This means the trend is already underway. Firms are postponing domestic expansion and diversifying production and capital overseas. The President's responsibility is not rhetoric, but fixing the signal. The President's role is not to alternate between shouting deregulation and tighter control, but to lock in a clear signal about how the state will treat the private sector under stable principles. Even if laws change, markets can adapt when the sequence of change, transition periods, and application standards remain consistent. When changes erupt simultaneously and interpretations diverge, markets withdraw. What the President must be accountable for is not pro-business slogans, but policy predictability. The Presidential Office also bears the final responsibility for external credibility. When the won wobbles, companies' dollar settlement costs rise, import prices climb, interest burdens increase, and foreign capital demands a higher risk premium. The very fact that strategic FX hedging and foreign exchange stabilization measures were mobilized amid the pronounced won weakness in the second half of 2025 is itself evidence that the market is already dangerous. This does not mean crisis management is unnecessary. It means the conditions for a crisis have started to grow. The first vicious cycle the President must cut is the demonization of the private sector. Agitation can feel satisfying for a moment, but if the system becomes one where the larger a company grows at home, the more it is attacked, investment shrinks, and factories stop. The public ultimately pays the price through the exchange rate and jobs. Responsible presidential politics does not inflame anger. It strengthens predictability. The National Assembly and the Ministry of Economy and Finance control corporate cash flows through the tax code. The corporate tax law determines a firm's final cash flow. Beginning in 2026, corporate tax rates rise by 1 percentage point by tax base brackets. 10% for KRW 200 million or less, 20% for KRW 200 million to KRW 20 billion, 22% for KRW 20 billion to KRW 300 billion, and 25% for more than KRW 300 billion. A 1 percentage point increase is not symbolic. It is a mechanism that reduces free cash first, the cash that would otherwise be used for equipment replacement, automation, R&D, FX hedging, and safety investment. The National Assembly's responsibility is not the politics of tax hikes versus tax cuts, but the operational design after a choice is made. Tax rates can be raised, but once raised, the duration of investment tax credits, permitting acceleration, advance regulatory notice, and a legally anchored stability period for core rules must be locked in at the statutory level. If tax hikes and regulatory tightening move together without a compensating package, companies stop expanding domestically and switch to overseas expansion. What leaves is not only factories, but also dollar earnings, jobs, and the technological base. Fiscal policy is also tied to foreign exchange. In July 2025, a supplementary budget of KRW 31.8 trillion was approved, with KRW 21.1 trillion financed through government bonds, alongside assessments that government debt would expand to about 49.1% of GDP and the fiscal deficit to about 4.2%. The more fiscal expansion grows while the growth engine stalls, the more fragile the exchange rate and interest rates become. The ministry's core responsibility is not short-term cash handouts, but a rules environment that lets companies earn profits and bring in dollars. The Yellow Envelope Act is about boundaries before rights. The Yellow Envelope Act, represented by amendments to Articles 2 and 3 of the Trade Union and Labour Relations Adjustment Act, is known to take effect on March 10, 2026. The key is how the expansion of the scope of employer and bargaining responsibility and changes to the liability structure for damages related to industrial action alter the expected cost of disputes. Whatever the intent, if boundaries are unclear, companies calculate using the worst-case scenario. The most sensitive setting is the prime contractor-subcontractor structure. The prime contractor controls delivery schedules, quality, and safety. If employer responsibility is interpreted in an expanding direction, the prime contractor effectively absorbs its partner's labour disputes as management risk. When bargaining becomes multi-layered, production planning shakes. When production planning shakes, export contracts shake. When export contracts shake, credit ratings and funding costs shake. This chain makes overseas relocation a rational choice. The union's responsibility is also clear. Korea's unionization rate is presented as 12.5% in 2023 and collective agreement coverage as 16.3%. Even with a low unionization rate, bargaining in high-impact industries can shape the cost structure of the entire economy. If unions fail to link wages and working conditions to productivity and technological transition, companies accelerate automation and reduce domestic production. Labour rights must be respected, but when disputes lengthen and boundaries blur, both workers and youth pay the price. The Serious Accidents Punishment Act must strengthen safety while fixing responsibility boundaries. The Act was expanded in application from January 27, 2024 to workplaces with 5 to 49 employees. Safety is non-negotiable, yet the point at which companies halt domestic investment is not safety spending itself, but unpredictability in responsibility attribution and criminal risk after an accident. Companies can intensify safety while still easily placing an option on the table to disperse factories overseas. The field is already under numeric pressure. A figure of 589 industrial accident deaths in 2024 has been mentioned. This is evidence for strengthening safety, but also means accidents are not treated as rare coincidences. They must be managed as a constant. If standards remain vague on how much is enough to earn liability mitigation, companies stop domestic expansion and move toward merely maintaining existing facilities. The government's responsibility is not punishment slogans, but operational precision. Standards must be made clear for when liability is mitigated if a company builds a safety and health management system and fulfills training, inspections, and investments. Responsibility boundaries between prime contractors and subcontractors must be made explicit in subcontracting structures. Procedures must be standardized so that firms can predict when disputes will end. A structure where safety strengthens while investment continues is created not by punishment but by design. Commercial law and capital market regulation must design for speed as well as transparency. Governance reform and shareholder protection are necessary. But when the system operates not only to make management transparent but also to slow it down, industries where speed is survival, such as semiconductors, batteries, AI, and biotech, delay decisions in Korea. Decision delays lead to missed investment windows. Missed windows lead to lost markets, and lost markets lead to shrinking factories. When board risk rises, companies become conservative. If the scope of responsibility expands and the likelihood of disputes grows, investment proposals are postponed. In sectors where 6 months can decide victory or defeat, the moment boards slow down, production and talent hubs can shift abroad. If regulation fails to keep companies both accountable and fast-moving, national competitiveness falls. The National Assembly's responsibility does not end with strengthening institutions. It must quantify how strengthened rules affect investment decision speed and R&D execution. If outcomes are poor, it must amend quickly. Responsible politics is not passage, but result correction. Discretion by regulators, local governments and supervisors explodes, permitting costs. Companies fear regulatory discretion more than regulation itself. If the same rules yield different outcomes because interpretations differ across enforcement bodies, firms divert manpower away from compliance into interpretation warfare. That cost cuts R&D, reduces hiring, and lowers productivity. Firms eventually migrate to jurisdictions with less discretion. Factory expansion triggers overlapping rules on environment, safety, traffic, electricity, water, fire services, and industrial sites. If ministries and local governments clash, timelines slip, financing costs rise, and contracts break. If schedules slip by 6 months, equipment becomes outdated, and orders move to competitors. At that point, domestic expansion turns into overseas expansion. This is the most realistic path by which companies leave. The responsibility of the President and the Prime Minister's office is not the word one-stop, but enforceable standard procedures. Permitting timelines must be fixed, the accountable authority must be unified, and interagency conflicts must be resolved by system design. Regulation must clarify its purpose while fixing schedule and responsibility so companies can plan. Finance and foreign exchange are both results and causes. Korea's foreign exchange reserves were reported at USD 430.66 billion at the end of November 2025. The current account balance for October 2025 was reported as a USD 6.81 billion surplus. There is near-term cushioning capacity. But cushioning capacity does not mean a crisis cannot occur. It only buys time, and if the structure worsens, the time is consumed quickly. If companies halt domestic expansion and shift the axis of production and exports overseas, the structural strength of the current account weakens. If one weakness persists, import prices rise, real income falls, consumption weakens, interest burdens rise, and debt vulnerabilities in households and firms grow. If foreign capital then reprices the risk premium, a small shock can become a large currency swing. The fact that defensive measures are repeatedly mobilized is itself evidence that the market is already dangerous. The Bank of Korea, financial regulators, the Ministry, and the National Pension Service must not shift responsibility onto one another. The central bank must manage volatility, the Ministry must safeguard external credibility, regulators must manage systemic risk, and the NPS must balance returns with FX risk. Yet all of these defenses are temporary. The fundamental remedy is a rules environment that keeps companies at home, earning dollars and creating jobs. The difference with the United States is not being pro-business, but having a policy package. The United States is strong not because it loves companies, but because it offers investment incentives as an integrated package. For example, the US institutionally guides an investment tax credit around 25% for advanced manufacturing investment. When a single factory is built, the game of after-tax returns changes. On top of that come access to procurement markets, standardized procedures, and predictable dispute resolution paths. Korea can tighten regulation, it can strengthen labor rights and safety, it can improve governance, but it must simultaneously bundle permitting acceleration, rule stability periods, faster dispute adjustment, and clearer responsibility boundaries. If one side is strengthened while the other collapses, companies keep Korea only as a sales and R&D base and move production abroad. Citizens are not exempt. If parts of the public lean on agitation and emotion to brand companies with original sin, politics and media exploit that emotion, policy becomes rougher and companies leave. The point is not to go easy on companies. The point is to demand high-quality rules and predictability. Decisions must be based not on ignorance and greed, but on facts and structure. Shared responsibility is the prescription and the path to lowering 2026 risk. The President must unify policy signals and state a stability period for core rules. The National Assembly must not treat the Corporate Tax Act, the Trade Union Act, the Serious Accidents Punishment Act, and the Commercial Act separately. It must assess the combined shock to investment decisions and adjust as a package. The Ministry must fix the duration of investment incentives and regulatory grace periods before tax rate adjustments. The Ministry of Employment and Labour must refine the boundaries of the Yellow Envelope Act to control expected dispute costs. Serious accident policy must clarify compliance standards and liability mitigation conditions to achieve both stronger safety and sustained investment. The judiciary and prosecution must remain strict while treating dispute closure speed and procedural standardization as national competitiveness. Regulators and local governments must reduce discretion and fix timelines. Unions must bear responsibility not only for expanding rights, but also for linking outcomes to productivity. Companies must bear responsibility to reinvest more at home when they earn profits here. Media and civic groups must design the public sphere with structural frames, not emotional frames. Citizens must judge by outcomes, not agitation. If this relationship network is realigned, companies stay, dollars flow in, the exchange rate stabilizes, and Korea can block a 2026 FX crisis. Thank you for watching Professor Namyong Lee's commentary, Long.